Alan Haig has stepped in. He's going to be presenting the industry and what he's seeing out there. So if you could give a hand to Alan, he's going to come up and explain that with his slides. Thanks.
Good afternoon, everyone. It's my pleasure to come and speak with you today. My colleague came down with a sore throat this morning and thought it wise not to bring that into this room in this era of COVID sensitivity. So you've got me. I'm going to speak today about what we're seeing today just in general industry conditions and also the buy-sell market, and then a little bit of a hunch for us as to what the future is going to look like post-COVID. And I'd really like to leave some time for feedback and Q&A, so I hope this can be not just a monologue, but a conversation today, because that's when I think we all learn more. So just kind of running through some stats. Used to be that profits were driven by SAR. That's disconnected right now, given the shortage of units. Are actually making a lot more money. So I think I'm kind of wondering, are the manufacturers going to see this? They're making more money now too, and change their production marketing plans. We have some dealers in the room today. Would you raise your hands? All right, how many of you believe we'll go right back to where we were and the factories will overproduce and margins will be $1,200 a car? How many of you believe that the factories will have learned a lesson, or retailers will have learned a lesson, and the margins will be higher in the future? Slightly more people. So that's the car dealer optimist, glass half full spirit, which I'm on the same page. I really hope that that's the case and that we've really learned that less is more for all of us. New days supply. This is the story of the industry right now. You know, we have half as many units in the system, really a third, and most of your units are pre-sold. So you technically are showing that for sale, but it's already gone. Used days supply has recovered quite nicely from where it was, earlier during the pandemic. So it's kind of back to normal, even though prices are far higher. So fewer units for sale, lots of demand from consumers. The law on supply and demand says that pricing has to go up, and it has. Profits have gone up about 50% on the front end. This data is coming from the public companies that have a lot of luxury brands in their mix. So if you're looking at your margins and you say, hey, I wasn't making $2,000 a car before the pandemic, imagine you had a portfolio of, a third of your vehicles were luxury, German luxury, a third were domestic, and a third were import. This is what these guys are saying. And look how consistent it was for the 5 years before the pandemic, right around $2,000, $2,100 a copy. Now they're making 70% more per unit retailed. And certain brands like Hyundai and Kia and Toyota and Honda that were trading at a big discount to where their sticker prices were, those are the franchises that we've seen perform the best in these times, meaning the most improvement on the bottom line, because so much of the gross is now sticking with those franchises. The luxury brands, they're already making $4,000, $5,000 a copy. Maybe they're at $5,500, $6,000 a copy, but not the same percentage increase as some of the more, I'm not going to call them discount brands, but the brands that discounted their products more. Used margins are also up, right? That's a substitute for new vehicles. If you can't buy a new car or truck, then you turn to the next option, which is used. That's seen about a 50% increase in front-end gross for the public companies. F&I, partly because the transaction prices have jumped up. So there's more financing to be done. And partly because if you're a dealer and you have fewer cars to sell, you might spend a little bit more time training your F&I people, trying to sell more product to offset that lack of supply. That's up 15%. When you combine it all, front and back end gross, the left side of this page, you'll see that's new vehicle gross, front and back. It's gone from $3,800 to $5,500 a copy. On used, $3,100 a copy to $4,100 a copy. So these are, to my knowledge, the highest profits that we've ever seen in our industry. The question is, how long will we stay there? I'm going to have to ask another poll from the dealers. Raise your hand if you think we'll be at the same level in 3 months. Raise your hand if you think we'll be there in 6 months. Okay, so there's real belief that this shortage is going to go on well into 2022. Fixed ops, this is something that I know a lot of you are focused more on now because you have fewer cars to sell, so you spend some more time maybe in the service department. We had a lot of cars stay parked in the garage or the driveway when the pandemic hit. Now the roads are filling back up. As I drive around the Boston area, I can feel it compared to last year when it was a joy to drive around Boston. So this fixed ops has come back up. It's mostly offset the decline we had before. I am a little bit worried if we have many more years of 15 million SAR, eventually units in operation are going to come down, right? And as units in operation come down, so might fixed. On the other hand, I spoke to a friend of mine who's a dealer in Massachusetts who's negotiating hourly labor rate increase to $230 an hour. So if we can see some of those labor rate increases across different franchises, we're going to have, we're going to more than offset any decline in the SAR. Expenses are way down at dealership groups. Some of that is because I don't have floor plan expense. Some of it is I don't have to advertise the cars because I don't have them. Customers are already coming to me. Some of it is because when the pandemic hit, a lot of dealers downsized or, or employees didn't come back to work. But the number of people working at dealerships today is a good bit smaller. I'm guesstimating people have about 20% lower sales forces. Does that sound about right? If you're a dealer in the room, does it feel about right to you? That's lower healthcare, lower training, all kinds of lower expenses. So the expense load has gone down significantly from about 80% of gross to about 65% of gross. So if you think about higher margins, lower expenses, here's the result in terms of pre-tax profits at dealerships. Again, this is NADA, so this is average private dealership. This is not public. This is average private dealers are out there. The average dealership was making about $1.5 million pre-pandemic. On the last 12 months, it's more than doubled. We have some groups that were representing that we're going at 4 to 6 million pre-pandemic. They're now at 25 million. So this isn't just a rule, right? Some dealerships have performed far better post-pandemic than they were before. Others, not quite as much. We're representing a BMW store now in the Northeast, and it was making about 5 million pre-COVID, and it's making about 5.7 now. They really didn't see a big run-up in profit. But this type of profit, I mean, we have a nice combination of dealers and CPAs in the room today, and I have to think it's really been a joy counting all that money the last 12 months. And now you're trying to maybe calculate the pain of paying the tax, what it's going to be now, what's going to be next year. But these have to be, albeit it came after a struggle from COVID and having to handle it, have to be the best times that any of us have ever had in this industry. I mean, I don't know how much longer it's sustainable, but it almost doesn't matter, right? People have been able to make so much money, reinvest in their people, begin to transition their businesses for the future, that this is an exceptional time, and I hope that we can all enjoy the last 2.5 months of the year, because I'm not sure it's going to sustain itself much past that. So in the buy-sell world, I mean, our firm, that's what we do. We do primarily sell-side advisory across the country. This year was a good year for us in New England. We sold a couple of Toyota stores down on the Cape. We sold a Subaru and Chevy store on the Cape, another Toyota store in Boston, a Subaru store in White River Junction, Vermont, and we've got another 7 stores that are pending this fall. So New England, I think, has seen more M&A in 2021 than it has in a long time, right? We have the Prime Group, which is going to close and be sold to Group 1. I think it's supposed to be mid-November. That deal is going to close. So that'll be about, including our work and others, roughly 70 or 80 stores that have sold in New England in the last 6 months, which I think is a higher rate of consolidation than what's happened in the past. And if the dealers in the room, I'm going to ask you to raise your hands again if you bought a store this year. Anybody close on a deal? 1, okay. How many of you looked at a deal and couldn't put it together due to pricing? Nobody? No one else is looking at stores? Okay. Well, the challenge right now is figuring out what is a store worth, right? This chart shows the number of rooftops sold dating back to 2015. And you can see, for the most part, before the pandemic hit, between private acquisitions, which are about 80% of the number of stores sold, and then the stores the public companies bought, it was roughly 350 stores per year, in that range. In the last 12 months, we sold 422, and by the time 2021 is over, I think that number could be at 600. So it'll be almost double the pace of what we've seen in prior years. And actually, as I think about it, it's going to be more than that because of the new RFJ deal that was just announced. So an explosion of buy-sell activity. This is the dollars spent by the public companies on buying dealerships. You can see, again, sort of prior to the pandemic, they were spending between $700 million and $1 billion a year on buying stores. I'm looking at the blue, the data that's in the blue bars there. That's domestic acquisitions. The red includes truck deals and international acquisitions that Penske does. So excluding those, we were $600 million to $1 billion a year in public company spending on M&A. 2020, it went to 2.5. This year, through half of the year, we're at $2 billion. And we know there have been several very large transactions that have happened that are going to probably triple this. So it's been an explosion of spending. So, one question is why? Dealerships are making more money than they ever have. They're more valuable than they ever have been. Why are dealership groups going out and buying so many of these stores now? And I think there's this increasing consensus that, that get big or get out theme is happening. The public companies believe that they need to be national retailers. They need to have all brands in most major markets, et cetera. We'll talk about Lithia's strategy in a few minutes. So I mentioned, how do you value dealership today? It's doubled in profit. Can you pay a normal multiple on that higher level of profit? What if you're concerned that margins are going to go back down? You will have overpaid for that store. But it looks to us like profits are going to continue for a while. So when we did our interviews with leading retailers that are buying stores, and we talked to our people that were buying the businesses that we're selling, and we looked at the prices that were being offered for the business that we're selling, we sort of backed into this math, which is the 3-year average, which is often how stores were valued before I got into the business back in the 80s and 90s. 3-year average times 3 times. That's what blue sky someone would pay. The public companies got into it in the late 90s and pushed that multiple from an average of 3 times to probably an average of 5 times today. But where we are on this is that most stores are trading for the average of 2 years of pre-pandemic profits, that's 18 and 19, and the last 12 months. You average those 3 periods together and you use a normal multiple. And that's kind of where we're seeing pricing come out for the stores that we're involved in selling. Sometimes we're off on the low side, sometimes we're off on the high side. But in general, this feels to us the way that the market is valuing dealerships today. So if you look at that in terms of, that's the pre-tax profit, and then times that, you have to have a multiple. This is what we're seeing in terms of multiples by franchise. They still vary widely based upon, if you're talking German luxury, where Porsche and Mercedes and BMW kind of sit at the far side of the left-hand scale. Or you go all the way down to, the Infinities of the world, where it's really not trading on a multiple because so few of those stores are really making money. It's really more of a dollar value. We've seen multiples elevate a little bit since the pandemic hit, but not significantly. Because I think people are saying, I've got to get debt on this. The banks are going to look at what the profit is. There's a certain ratio I can use. So the multiples haven't changed that much during the pandemic. It's really the multiple of the profit. The average profit is what's moved up a lot. So these multiples are generalizations. They vary on every deal, and they depend upon local factors, such as if you're in a metro market, typically the multiples are going to be this or higher. If you have an underperforming store, the multiples are going to be higher than what we said in that last chart. If you're in low tax markets like Florida and Texas, the multiples are typically going to be higher than what we have here. Conversely, sometimes we see the multiples come in lower. If you're in high tax markets, people can pay a little bit less because they're going to have less after-tax cash flow to service debt and to get a positive return on investment. If you're in a rural area, there are just not that many buyers. There's less competition for those stores, so it's hard to command a premium price. If you're in a slow-growing market or a market that's losing population, sometimes it can be hard to get somebody to invest a significant amount of capital to buy your business. If you have an add point coming, you're going to lose some market share, you're going to lose some profits, so buyers are going to be more conservative. If you haven't invested in your real estate and the next guy or girl is going to have to come in here and put up a new $15 million facility to replace the one that you have that's aged and no longer compliant, that's got to come out of either the real estate value or the blue sky or a little bit of both. At any rate, when you kind of put all the sausage together in terms of earnings, multiples, this is where we see average blue sky for a typical dealership today. Pre-pandemic, we had blue sky value in the mid sixes, high sixes, low sevens over the last 10 years. We're now at 10.3 million. So it's gone up about 50% since before the pandemic. 50%. So there's been a lot of M&A that you've seen this year. We talked about all the buy sells that have happened. That's a combination where some sellers are saying, hey, between my high profits today, which are bringing high values today, and the rush for the exits to be able to sell at a 20% capital gains rate, the confluence of those two events, high prices, low taxes, led to the explosion of M&A that we've seen here in 2021. Now, what's going to happen next year? Where will the dealership values go? My sense is that they'll slowly contract. I'm hopeful they're going to land higher than where we were pre-pandemic, because I'm hopeful the profits are going to remain higher as well. But this, if you look at the last 3 years kind of growth, I mean, it's been a special time. And so the question is, well, why would somebody buy a business when it's disinflated, right? And I think they're looking at that last 3 years of earnings, and they're almost flipping that mirror and projecting it forward. So I think 2022 is going to be really good. Maybe not quite as good as 2021, but it's still going to be an excellent year, maybe the second best year for profits ever at dealerships. 2023, they'll still be coming out of some shortages in inventory, et cetera. Interest rates should still remain low. So 2023 is probably going to be better than the two pre-pandemic years of 18 and 19. So if you take that last 3 year average and you flip it forward, we're seeing buyers are believing they're going to get the same amount of profits in the next 3 years as what existed in the last 3 years. So they can afford to pay more because they're going to be getting more cash than they would have pre-pandemic. So it's interesting to see how the market kind of adjusts to the various variables that go into their projections, their financing, their outlook. Buyers are inherently optimistic, right? They're taking the long view on our industry, otherwise they'd be sellers. So it's been fun for those of you who had friends who have sold their businesses. I'm guessing they're, talking, I think the Fort Lauderdale Boat Show is right now, and I'm guessing they're on the dock talking with their yacht broker about is it 120 or 165 foot boat they're going to get. But it's been fun for us to represent clients to help them achieve their exits, because it's definitely been fun numbers that are showing up on the closing statements. So it's not just private values that are high. This shows the stock price performance of the public retailers. The gray is the franchise retailers, so that's the AutoNations and the Sonics and the Penske's. The darker red is used retailers, so that's CarMax, Carvana, and I think Vroom we have in there now. And then you can see over the last 3 years, in every period, auto retail is outperforming the market by a good margin. So these are indeed the best of times for auto dealers. Okay, so right now it's about as good as it can get, right? I mean, do we see it really more? Do we see more profits? Lower taxes than we've had in 2021. It would be nice to think that we would in my lifetime, maybe, but maybe not. So going forward, what do we see some dealers talking about as concerns, and what can they do about it now to prepare? So thinking back pre-pandemic, do you remember these threats that people talked about? Electric cars are going to take over, and people are not going to own cars anymore. They're just going to press a button on their phone, and Uber's going to show up and take them. Autonomous vehicles, people won't be driving. There'll be these fleets. Well, it'll be Hertz will own it or AutoNation will own it. There'll be these fleets that drive around and pick people up. Those were some of the things that were weighing on values of public companies, and I think in the minds of some families that said, hey, do we want to stay in this business? Is it going to change a lot in the next 20 years? And if so, maybe we want to get out. But if we think about it now, and it's just 3 years later, right? I mean, ride sharing is not really a threat, I don't believe, to auto dealers. I think some auto dealers have learned to service the Uber drivers, et cetera. It can be profitable for them. autonomous vehicles don't appear on the horizon at all, either because of technological issues or cost issues or the liability. Electrification, I've still yet to see a study that shows how much gross might be lost by dealers from not doing oil changes and replacing alternators and fuel pumps, and how much might be gained by replacing battery packs or replacing all the sensors on these vehicles as they get increasingly complex. So that to me is a question. So to me, the one big potential risk, I shouldn't say the one, but one of the biggest has to do with people, customers and employees. You know, what's different about them since the pandemic's hit, and how would dealers respond to that? And so for starting, let's talk about on the customer side. How many of you get your groceries delivered today by some service, Instacart or whatever? We go to the grocery store maybe once a month now. We used to go every week. How many of you get a package every week from Amazon? Right? How many of you have bought a residence sight unseen? Right. Would you have ever done that 2 years ago? I can't imagine having done that now. So I think that the ability that people have to trust themselves through a service that they trust, to purchase goods that can be complex, like groceries. Like, do you get the good bananas? Do you get the organic? You know, people figured out how to do that. Real estate, you know, you can go on an online tour with Zillow or whatever, and you can get a pretty good sense of what that unit's like. And you can look at the neighborhood and the stats and how it's sold and what the tax base is and everything else, almost as good as if you're there in person. So that's changed. And customers are more comfortable buying at home. They're more comfortable buying from bigger companies. And I don't think that's going to change. I mean, my kids, where's my phone? The last car I bought from a dealer who was a friend of mine. It still took me 3.5 hours to get out the door. And I wasn't negotiating. I just said, tell me what it is and I'll pay it. My kids are going to press a button on here, whether it's for an Uber ride or whether it's an app that allow them to lease a vehicle or purchase a vehicle. I just don't see them going to the dealership and spending hours negotiating a car deal because they're used to doing this, buying stuff online, sight unseen by pressing a button. So let's talk about the two companies that I see leading our business today. Carvana is a company I hadn't heard of 3 years ago. Anybody ever know of them before last? They've been around about 7 years now, but 3 years ago they popped up on my head because we bought a house in Plymouth, and we wanted to have a little Jeep Wrangler to keep down there in the, for when we were here for the summers. I called a friend of mine, one of the guys who owns Colonial. Is anybody here from Colonial? They had a Jeep Wrangler at their place down in North Dartmouth, and it looked like it met what we wanted. So I called Pat and I said, is it really there? And will you hold it for me? Because it's 40 minutes away. Sure. So I went and looked at it, and he told me the price, and I bought it. But the week before I did that, I'd been out in Phoenix, and I'd seen what Carvana was doing. So I went to the Carvana website. Has anybody spent any time on the Carvana website? Okay, so in South Shore of Boston, I found 0 Jeeps at my local dealership that met. I found 1 Jeep 40 miles away that met my needs. Carvana had 37 that met my needs, and I could see all the flaws. I could see the Monroney sticker that showed exactly how that Jeep was built and what the original price was. So it created a lot of value for me. Like, wow, I'm only buying this for $25,000, and it sold for $35,000 or whatever the numbers were. And then there was a clock that said if you buy this vehicle in the next 5 hours, 15 minutes, and 23 seconds, 22 seconds, 21 seconds, it'll be delivered to you tomorrow by 2 p.m. And then it also had a little clicker at the bottom screen that said like 18 other people are looking at this vehicle right now. And a bunch of vehicles I couldn't even look at because they were already under contract. So it created a sense of urgency. So it gave me a ton of information, a ton of selection, a ton of convenience. I almost didn't really care about the price at that point because I figured, hey, if 17 other people are looking at this car, it's got to be priced at market. So I didn't buy from Carvana because I'm loyal to the franchise system, but my kids probably will because it's so damn easy. Here's the growth they've had in the last 5 years. 244,000 cars last year. This year, they're probably going to sell over 400,000. Here's the revenue. You know, they're going to blow through probably $10 billion in revenue this year. Gross profit per unit, they're getting better and better. Now they're profitable. A lot of people thought this company would go away. There's no way they can make money. Their business model is flawed. It's different than a normal car dealer. They don't make as much money on the front end. They have way higher delivery expenses. They make a lot of money through their finance company. But to me, this is kind of an opportunity for dealers, because I think dealers have got an advantage over Carvana because they have a physical footprint. You know, customers can, it's still convenient for a customer to come and pick up a vehicle. But they've made it really easy for people to buy from them. We talked about changing consumer behavior. 86% of customers, we know this, go online to search for vehicles before they come and buy one. 61% would now consider buying a vehicle online. There's no way it was near this pre-pandemic. I mean, I wouldn't have. 52% drive only one vehicle. So that physical presence is less important than it used to be. This is their advertising. You know, I'm just putting it up here, but you know, you can search it from any device. You can do all your trade-ins, all that stuff, all your financing online. 10 minutes to complete a purchase. Remember I said I was in there for hours, and I wasn't arguing, I wasn't negotiating. And they're saying it's $1,000 in savings. Now, I don't know how they measure that. To me, that's a specious claim, because I can't see how they could do all this and save me $1,000. I would think they would just raise their price by $1,000. But look at what consumers say. 4.7 rating. Raise your hand if your group has 4.7 rating or higher. I don't know if any dealers have this high rating. Does anybody have that? Okay, congratulations. That's impressive. 96% would recommend to a friend. So here's the results. Their stock price now is trading at about $300 a share. It goes up and down a little bit. Market cap, they're worth $50.5 billion. That's the value of the equity. That doesn't include all the debt. So that's double CarMax and about 50% higher than all the other franchise retailers combined. So that's Penske, plus Lithia, plus AutoNation, plus Asbury, plus Group 1, plus, I'm forgetting one. All of them together are worth less than Carvana. So the market, the investors believe that this is the future, that these guys can take share profitably for a long time, and they're going to do that, and where they're taking that from, the fear is they're going to take it from my clients, you know, who own typically 2 stores to 5 stores, right? That those dealers are the ones that could be at risk because they don't have 100,000 cars in inventory. They don't have a world-class website, et cetera. But they could. So let's talk about Lithia. Lithia announced that it wants to have $50 billion in revenue by 2025. They announced that in 2020. They're way ahead of that plan already. Their goal is to have a dealership within 150 miles of every consumer in the country. And then those they can't reach locally, they're going to use this app, My Driveway, to sell and service remotely and do pickup and delivery for sales and service. They've invested over $75 million so far. They're going to sell 15,000 dealerships through that this year. And they've got their finance company tied into it too, just like Carvana has. So it's not practical for almost any dealership group to spend $75 million building an app. But Cox could, Reynolds could, other software providers that are already well established and maybe already visiting you, I'm hoping are going to be doing all this, the digital retailing, the world-class navigation, the ease of financing, the ease of trade-ins, the ease of continuing to contact that customer with service opportunities, et cetera. So I don't believe that Carvana and Lithia are going to put car dealers out of business, but I think they are going to take a lot of share from those that are a little bit asleep and are not proactively taking these types of technology that consumers clearly want to interact with and blending it into their businesses. So this is interesting to me as a guy who's been in M&A most of my career. You know, there's a dirty secret of M&A, which is Most deals don't meet the buyer's expectations. They fail to deliver in some way. People overproject, they underestimate risk, something happens. But this is, again, data coming from Lithia, that they're saying they're able to take stores that they're buying and significantly increase the market share, increase sales, increase F&I, increase fixed, reduce expenses, and increase pre-tax profits by going from 1% to 3%. So that's a significant increase in the performance of these businesses they're buying. And that means that the factories are going to let them keep growing. Like if they bought these stores and broke them, like we did at AutoNation back in the 90s, you know, what happens, the factories just tie you up with framework agreements, you can't buy any more stores. And there's been no growth at AutoNation really for 20 years. But Lithia is able to buy these stores, and they're doing something operationally, technology, et cetera, to improve the performance. So it's a win for the Lithia shareholder, it's a win for the factory, and it looks like it's a win for the consumer as well. So these groups that have got it figured out, where they're blending M&A plus operational excellence plus technology, and that's kind of the perfecta, if you will, and they're going to continue to grow at least for the next 3 or 4 years before they evolve to more of a digital strategy. I'm not going to let, you know, I won't go through all this, but this is what their app can offer now. It's basically the same things what Carvana is doing, except with My Driveway, it's new and used. So I've not seen the same technology come out of CDK or Reynolds yet, where you can have a website that offers all of your inventory to every customer in the country, pick up and delivery, any brand, anywhere, financing, trade-in, negotiation-free, instant financing, all that stuff. I mean, it's pretty compelling. But none of this is proprietary. You can't patent any of this, to my knowledge. This is just stuff that people are already doing. These are normal practices. But if you don't implement them, that's where my fear is for dealers. So look at what's happened with Lithia since they announced this acquisition strategy. Look at the amount of capital that's come their way. They've raised billions of dollars, the stock price has tripled. So the market likes growth, and the market likes leadership in terms of giving the customer what he or she wants, the factories what they want, and doing that in a way that's profitable for the owner. So does anybody know Brian Benstock from Paragon? He speaks a lot. I'm guessing many people have seen him speak. Okay, so this is he was offered, Paragon Honda has always been one of the highest Honda stores, and he has an Acura store in the country. I would say normally top 5. But if you went to his facility, it's tiny. I mean, maybe there are 4 cars in the showroom. I think he's got fewer than 20 service stalls. They're parking cars on the sidewalk in front of the dealerships. The neighbors hate them. But when the Honda store went out in Manhattan, Honda came to him and said, "Brian, do you want this point?" He goes, "No. I want to show you that I can sell and service Manhattan, but without a physical presence." Well, how are you going to do that? Well, I'm going to get this big storage lot north of the city, and I'm going to have an app, and I'm going to have drivers, a bunch of porters, and we're going to communicate with people that are interested in buying or servicing a Honda in Manhattan, and we're going to do that through pickup and drop off. And I think when I click this button, it's going to show the number of, here we go, see this populating? And you can see the date on the left side there. For me, that's pretty incredible. He's doing this all through pickup and delivery, right? These are customers that are not coming to him, he's going to them. So, and his dealership is more or less right there. So I think Honda's pretty happy, right? Those customers are being served. There's no physical presence there. He's got an inventory storage site north of the city. He's got some bays scattered around different places. He's going 24/7 on service. It's really a good example that facilities, giant palaces, are not necessary to do incredible work for customers. But he didn't invent all this. He just had the desire to do more. And Brian's, you know, in my opinion, one of the most, you know, forward-looking dealers. He wasn't content to sit there in a small store and just sell to his local people. He knew he could do better. And with the help of a software provider and a service provider, he was able to put together the service. So, a customer has an app on their phone, and they may get a call saying, hey, it's been a year since you've come and seen us. We need to come and do an oil check and an inspection. Click here for what time you want us to pick it up, and click here to confirm the location, and the customer will do that. And then they get a text back from the customer saying, hey, we finished your work, but we noticed the 2 tires are low, and here's the photograph. Click here if you want us to do it, and here's the price, and click here if you don't. And what he's found is that the customers, when they're waiting in the store and you say, hey, you need a couple new tires, the customer says what? How much and how long? And it's almost never soon enough, right? So a lot of them say, I'll just do it the next time, so they leave. But if they're at work and the car's already in the shop, it's not inconveniencing them anything more to have the work done. In fact, it's kind of a convenience because they don't have to do it again in the future. So what he found was not only was he doing more ROs, but the average value per RO more than doubled. So here's some data. You can see on the left-hand side is for his ROs where he came and picked up the vehicle, it was about $600. This is for customer pay, this is not warranty. For those that brought the vehicle in, the average RO was $283. So he more than doubled his RO. Now, what I don't know is what the cost of that pickup and delivery is, right? I mean, there's a real expense there, and I don't know how much of that gets eaten into the gross. But I would think that Manhattan is about the hardest place in the country to do pickup and delivery, given the congestion and the distances. So these are the threats that we see for dealers post-pandemic, right? Right now it's so good, like we're kind of bulletproof. We already talked about the customer experience. I'd like to talk a little bit about OEM control, because right now we're getting full gross or pretty full gross for many of our products. But when we come back down from this really exceptional time we had because of limited inventory, we think that the best dealers are going to need to be experts at mastering the OEM incentive programs, right? Between, are you selling enough CPOs? What is your facility like? How's your customer service? Are you selling enough of our parts? What's your market share like, et cetera? That those dealers that can master I mean, some factories are harder than others, but can master this will have greater control of their future, right? Because they're going to be making full or almost full profit on these vehicles versus the dealers who have a substandard facility, their CSI bonus is not coming in, et cetera. This to us is a key thing for dealers to be successful in the future. People is another aspect. You all see this more than I do. I hear this through my dealer friends, but it's been hard to recruit and maintain a sales force because millennials are like, I'm not coming and working on full commission. Millennials often want to have a sense of purpose where they go to work, not just a paycheck. Salespeople have been unfairly depicted as greedy, slimy, lying folks, and no one wants to be that. On the service side, our society has taught everybody they should go to college and not taught them there's great honor in working with your hands. So there's some dealers that I see that are not just accepting what walks in their door, but they're trying to attract and train great people. Anybody know Don Flo, dealer out of Greensboro, North Carolina? He has a belief, he's got about 30 stores, and he has a belief that national scale doesn't really matter. It's really local scale that matters, from getting customers but also people. And so he has a program where he recruits kids out of college, and they have a career path. You're going to come and you're going to work in the BDC for 6 months, and then we're going to put you in a product specialist, and then we're going to put you in a sales job, and then we're going to put you on the service drive, and then we're going to put you in a management position. And over 5 years, you're going to develop into where you're in a position of management. And he says to each of his managers, like, I'm hiring these kids, I'm paying the training, they're going to work in your store, but in 5 years, I may pluck them out of your store and put them in a different store, and you can't complain because I've done the investment on my own. And they like that, and they get that because they get good managers too. And so he believes he's creating a pipeline of talent to his business that will allow him to outperform his competitors. Now, That's a long-term view. It's expensive, et cetera. I don't know if anyone else subscribes to that. But I think that the groups that do that are going to be able to attract and retain the best talent. And even if we have a great website, you know, Carvana's got a great website, but they've got an incredible amount of talent behind the scenes that's creating all that software. And I think that dealer groups need the same thing, right? I mean, we have the fortune to have these global manufacturers that research and develop our products, produce our products, market our products for us, pay us to fix the products, right? So we have a lot of advantages. But having access to the best people, I think, is what separates a good dealer from a great dealer. It's an oxymoron. I think AutoNation, for instance, kind of lost the balance for the battle for talent in our industry, because I think they felt like, hey, we'll just put in place processes and the individual managers won't matter as much. The best dealers that I know, they don't mind spending $700,000 a year on a great manager or $1 million a year on a manager if that manager's bringing in $7 million or $10 million in profit. Other companies will never think about that, right? I mean, AutoNation would never pay somebody $1 million to run one of their stores, I don't believe. So we don't want to be dire here. I mean, we think, you know, auto dealers have got a long-term outlook in our industry that's going to be successful. But it's in our interest, selfish interest, to have dealerships be worth as much as possible, because when we sell them, we make a commission off that sale. So we want them to be as profitable as possible. These are our ideas. You know, you all are the dealers. So do we have any time for Q&A? Yeah. Anybody want to react to what we talked about up here? Agreeing with it or disagreeing or other ideas? All right, I might have to call someone. Okay, we have a question.
You mentioned the multiples now are more based on 18, 19, and 20.
Last 12 months.
18, 19, and the last one.
Yeah, not 20. So
And so is that, the last 12 months, is that, do you include or exclude MVP?
we exclude that. Yeah, because that's purely non-recurring. Yeah. Yeah. Well, let me ask the dealers in the room, what's your greatest focus coming out of the pandemic? Where are you going to be investing time and money to improve your business? Anybody want to volunteer? Usually the great thing about these groups is people can share some information. It's just information.
Incoming inventory on the website. Things coming, you know.
Okay, try to pre-sell a unit. So then you're kind of pre-selling it, which protects your gross. Yeah. What about those things that Carvana does, where they have, you know, all the great, I mean, I know some dealers have invested in the photo booths and have it, but, you know, the digital Monroney sticker that shows how the vehicle's built, the little pictures that show some of the scratches, the clock that show, or how many people viewed this car. Is anybody doing any of those things? I encourage you to go spend an hour or two on the Carvana website. I think you might be able to learn some things from visiting it. Well, I don't know if people agree with everything or agree with nothing. So, no other questions? Okay. Thank you all.